Hello YouTube, Herman Williams with ATM Financial Services here again with another Money Smarts lesson to help you take control of your finances. Today we're going to talk about the benefits of having an emergency fund. Now by definition, an emergency fund is money that you set aside to cover your essential expenses for a period of time in the event you were to lose your job. Now, I will tell you though that an emergency fund goes way beyond those boundaries and has many benefits for you while you are working or retired, and not just when or if you become unemployed. First, let's talk about the unemployment piece and how you should plan for that possibility. Most financial advisors will recommend that you have 6 to 8 months worth of essential living expenses set aside in case you lose your job unexpectedly. So first of all, what are essential living expenses? Well, essential living expenses are those expenses that you must pay in order to survive while you're searching for a new job. I'm referring to things such as your rent or mortgage, essential utilities, and when I say essential utilities, I'm not talking about your cable bill or your subscription to Netflix. I'm talking about your water, gas, and electric bills. To determine how much you need to have in your emergency fund, start with your monthly budget and then eliminate everything that you don't absolutely need in order to survive. Whatever is left over are your essential expenses for the month. Once you determine that number, then multiply it by either 6 or 8. What I like to recommend is that for single households, you should budget for 8 months worth of expenses, and for 2-income households, you can probably get away with 6 months worth of expenses. The thinking here is that the chances of losing both incomes at the same time are not as likely as it is for a single income household. Although I should point out that there were a lot of couples who both lost their job during the last financial/housing crisis back in 2008-2009 timeframe. So that's the basic theory behind having an emergency fund. Now let's talk about some of the other benefits of having such a fund. When you have money saved, it can save you money. Let me say that again. When you have money saved, it can save you money. For example, when you have money saved, you may be able to raise your deductible on your car insurance and thereby reduce your premium. If your current deductible is $500 and you raise it to $1,000, you would see a slight reduction in your premium. If you have multiple cars insured, then obviously the savings would be higher. The savings is also greater if you go from $250 to $1,000 on your deductible. Now I know that seems like a big jump for a little bit of savings, but think about it this way. On average, the time between automobile accidents that result in a claim being filed is roughly 17.9 years. Now we all know that one person who seems to have an accident every year, but that is the exception rather than the rule. Also, just because you have an accident doesn't necessarily mean you will be paying a deductible. If the accident wasn't your fault, then the other person's insurance should cover your repairs. So assuming you are a fairly safe driver, the premium saving will eventually cover the increased deductible. Exactly how much you will save by increasing your deductible depends on a lot of factors that are specific to you, your insurance carrier, and your automobiles. So you should consult with your agent and calculate the payback time before making this decision. Now there are multiple other areas where having an emergency fund will have a bigger impact on saving you money. There are many other emergency situations that crop up in everyday life where having an emergency fund can save you money. What happens when the AC in your home goes out in the middle of August and it's going to cost $1,000 or more to facilitate repairs? If you don't have an emergency fund, where will the money come from? I can tell you, if you live anywhere in the South, you are certainly not going to let your family suffer in the stifling heat. So chances are you will pull out the credit card and get it fixed. And here's the thing, if you didn't have the cash to pay for the repair at the time of the failure, chances are you won't have that cash when the credit card bill comes in. So now you are paying interest on that $1,000 or more, and depending on the credit limit on the card that you used, you may also negatively impact your credit score. If you haven't watched my video on understanding your credit score, please do so. The same type of situation could arise with a needed auto repair or home appliance replacement or any number of other unplanned expenses. So as you can see, an emergency fund can have a lot of benefits other than providing temporary coverage of essential household expenses when you lose your job. So now let's talk a little bit about where you should house your emergency fund and how you can get started. First of all, whether we are talking about saving or investing, we always want our money to be working for us. And when I say working for us, I mean it should be earning money and therefore increasing in value. So what are our options? Well, obviously just putting the money in a cookie jar or stuffing it under your mattress is not going to earn you any money. Yes, you are saving, but your money is not growing. You are also putting your money at risk of loss due to fire or theft. There's also this thing called inflation that makes the money you set aside today worth less tomorrow. So you want the money you set aside to be earning something to help offset the effects of inflation. One option would be to open a savings account at your local bank or credit union, but those accounts are currently paying very little interest, in most cases less than 0.5%. You could also open what is known as a money market account with the same bank or credit union, and that type of account usually pays slightly more than a regular savings account, but currently most of those are still less than 1%. A better option might be to consider using one of the online high-yield savings accounts. And there are a number of options to choose from, and some are currently paying 1.5 to 1.8% and perhaps slightly higher. You may just need to shop around a little bit to find the best rate. It is important to note that the rate that the financial institutions pay on savings account varies with the rate set by the Federal Reserve. When the Fed lowers rate, the interest rate paid on savings will also likely be lowered. But the reverse is also true. When the Fed raises rates, your savings rate will usually tend to rise. Wherever you choose to house your emergency fund, just make sure that the account is FDIC insured. So once you have determined your target amount and decided where to house it, how do you get started? Well, it has been my experience that generally when people say, I'm going to put X number of dollars a month into a savings account, meaning that it requires some action on their part to make that happen, they're usually not going to stick to it consistently. Even if you can log into your account and do it from the comfort of your sofa, which you can do these days, it is still too easy to not stick with that plan. Life happens. We get distracted and we come up with reasons why we can't do it this month or next month. So a better approach is to have this set up to happen automatically. If you decide to save with a bank or credit union where you already have an account, you should be able to set up an automatic internal transfer. And even if you use one of the online accounts that I mentioned, you can link it to your checking account and have the transfer take place on a date of your choosing each month, and usually without any fees attached. The beauty of this method is that usually in a very short time, you become used to that amount not being available to you, and you don't even think about it anymore. Most of us adjust our spending behavior to what we have available to us. When you have more, you tend to spend more. It's just human nature. When you have less, you tend to spend less. So adjusting your spending in order to save becomes a learned behavior. If you haven't realized it yet, you will hear me speak about behaviors a lot in these lessons. That's because I believe in the old saying about, if you give someone a fish, you feed them for a day. But if you teach them to fish, you feed them for a lifetime. I want to teach you behaviors that will feed into your goals for a lifetime. Even if you can only afford to save a small amount each month, set it up to happen automatically. After a little while, you may realize that you can actually save a little more than what you thought. So you just go back in and increase the amount that is being transferred each month. Once you start to see your savings grow and realize it wasn't as painful as you thought it would be, you will be inspired to do more. And bingo, just like that, you've learned a new behavior that will have long-term benefits. Now let's talk about the folks who are already retired for just a moment. Even though there's not the threat of losing your job, you still have life to deal with and things to plan for. Actually, in some ways, it is even more important for retirees to have an emergency fund because you are more than likely on a fixed income. Some of the things a retiree may need to think of when trying to determine how much they need to have set aside are things like, how much will it cost to replace the roof on your house? This can be a significant cost, and most people don't think about it until the roof starts leaking. Other things that a retiree may need to plan for are things like a new set of tires for your car or truck, or perhaps a new car or new truck. You may also need upgrades to your kitchen or bathroom. These can be expensive projects, so having at least some of the money already set aside can save you money in interest on a loan or a credit card. It can also eliminate the need to pull money from your retirement account, which is a biggie. If you are retired and fortunate enough to have an IRA or other retirement account, you don't want to have to pull significant amounts of money from those accounts unexpectedly. For one thing, it reduces the amount of money you have working for you, so you are losing some of the value of compounding. You could also be shortening the life expectancy of your retirement account. In other words, you may run out of money sooner than expected. There are also tax implications when you pull money from your retirement account. Unless it is a Roth account, you will have to draw more than you actually need to cover taxes. I will talk more about Roth accounts in another lessons. But this further reduces your working capital. If you have set up an adequate emergency fund prior to retirement, you also now have a head start on funding your bucket list. So whether you are just starting your career or enjoying your golden years, an emergency fund can save you lots of money and provide you with peace of mind. Well, that concludes the lesson on emergency funds. And as always, I hope you have found this information useful and informative. If you haven't subscribed to my channel, please do so by clicking the subscribe button down below. And if you like this video and like this lesson, don't forget to give it a thumbs up. And until next time, behave well.